Hello everyone, and welcome back once again to Energy Transition Trends, where we review the goings-on across the energy transition space. 2021 proved to be a volatile year for energy transition equities, as supply chain bottlenecks, logistics disruption, and inflationary pressures all around the world weighed on company earnings and valuations across the space. The big picture set up into 2022 was sadly not dissimilar, with inflation accelerating to multi-decade highs and supply chain bottlenecks still very much constrained. The big difference this time round, however, was that valuations, particularly after a difficult January, had very much reset, and so we were certainly optimistic of a more positive performance outcome over the full course of the year. Then, just as we were starting to see tentative signs of supply chain pressures easing, we saw a rapid escalation of the tensions in Ukraine, with the conflict adding further fuel to the inflationary fire and throwing supply chains globally back into risk. Of course, our first thoughts during this difficult time are with the people of Ukraine. But stepping back from the humanitarian crisis, we need to try and consider some of the potential investment effects. Broadly speaking, we see three potential risks associated with the tensions in Ukraine. The first is more prolonged and severe inflation. With energy prices now well above $100 per barrel and key metal and agricultural prices accelerating too, it seems difficult to see a world where inflationary pressures ease, at least in the near term. The second concerns supply chains. Together, Russia and Ukraine are key exporters of critical metals such as nickel and platinum, as well as neon, one of the key materials used in the manufacturing of semiconductor chips. Companies across the energy transition universe that are reliant on these key materials could see their earnings under threat if tensions in the region continue for some time. And finally, we're now starting to have to consider the potential risks of an economic slowdown. The current outlook is clearly troubling, but it's important to step back and remember there are some positive potentials too. The first is that the bigger picture need to transition our energy system is completely unchanged. Our world is still emitting 36 billion tons of carbon globally per year, and we need to get this to zero if we're going to meet our climate goals. And the only way to do that is to increase the amount of clean technologies that we're using globally. It's important to also think that the current tensions in Ukraine potentially add further credence to transitioning our energy system towards a new, cleaner, more secure environment. As valuations have pulled back in certain subsectors, opportunities are emerging. But we have been surprised by the remarkable rebound in renewable names as concerns around energy security have emerged. Yes, there are market risks around inflation, supply chain bottlenecks, and economic growth, but the long-term structural opportunity behind energy transition equities really hasn't changed. Companies like Vestas in the provision of wind turbines, Alfen in the provision of EV chargers and energy storage and smart grids, and even companies in the green hydrogen supply chain are looking increasingly attractive as we need to meet our decarbonisation and energy security goals.